Welcome to this explainer. Today, we're unpacking how a series of massive regulatory moves in early July 2026 just turned the Indian financial market completely upside down. You know, if you've ever thought financial compliance was just some back-end administrative headache that you can safely ignore, well, this week's events are a massive wake-up call. We are diving deep into a sudden, sweeping series of enforcement actions that are literally forcing immediate corporate risk overhauls across the entire financial sector.
To really grasp the stakes we're dealing with today, we have to ask a pretty critical question. What happens when the very foundations of financial compliance are challenged by hallucinated court cases, closed brokerage loopholes, and deceptive bank apps, all at the exact same time? Well, the answer is that the regulatory floor just cracked wide open. So whether you're an algorithmic trader, a major bank shareholder, or maybe a risk officer trying to manage these new AI tools, the rules of the game have fundamentally changed. We need to look directly at the framework data to see exactly how to protect your portfolio.
All right, so here is our roadmap for today. We're going to start by looking at the July system shock, then move right into SEBI's brokerage crackdown. After that, we'll explore the RBI's consumer defense matrix, tackle this newly emerged AI threat horizon, and finally wrap the whole thing up with the overall market impact and fallout.
Let's kick things off with Part 1, the July system shock, and look at the immediate, high-stakes chaos that just hit the market this week. In just a few short days, we saw three massive simultaneous shocks hit the ecosystem. First, the Supreme Court literally threw out corporate tribunal orders because of fake AI-generated precedents. Crazy, right? And at the precise same time, the RBI launched a major, strict consumer defense framework with some incredibly heavy penalties. To round it all out, SEBI rolled out a critical compliance circular targeting the handling of unpaid securities. Honestly, any one of these would be a major news event on its own, but all three happening at once? That is a true system shock.
Moving right along to Part 2, SEBI's brokerage crackdown. Let's see how this new July 3rd circular is completely changing the way your stockbroker is allowed to handle your unpaid securities.
So, on July 3, 2026, SEBI officially dropped a massive circular that entirely rewrites the operational guidelines for the handling of client unpaid securities by trading members. Basically, SEBI is now mandating that trading members shift these assets into a dedicated, tightly monitored client unpaid securities account, we call it a SUSA, or they have to liquidate them within strict regulatory windows. This completely replaces the old shady practice of indefinite holds. It means your assets are now strictly segregated and, most importantly, tracked.
This contrast really brings it to life. In the past, under the old loophole, brokerages could just hold on to your unpaid securities indefinitely. They'd pull them together to artificially boost their own internal trading power. It was wild. But now, under the new rule, that is totally over. SEBI has hard-coded explicit timelines. We're talking strict CISA rules and mandatory liquidation windows. The ultimate goal here is the total protection of retail assets from brokerage insolvency risk. They have completely locked down that systemic loophole for good.
Okay, let's pivot to Part 3, the RBI's consumer defense matrix, where we'll look at the commercial banking infrastructure now that this aggressive new framework has officially gone live.
This is an absolute game changer for the banking sector this July. See, for years, major Tier 1 lenders would inflate their profits by aggressively forcing third-party products, like life insurance policies or maybe credit cards, onto retail borrowers right in the middle of getting a loan. It was a notoriously aggressive cross-selling environment. But under this new mandate, that aggressive inflation of non-interest fee income is being directly targeted and frankly dismantled by the central bank.
So gone are the days of classic mis-selling tactics like hidden pre-checked digital boxes and highly deceptive interface layouts. Under the RBI's severe new regulatory action, financial cross-selling has to default to a mathematically hard-coded, explicit choice. You actually have to opt in. It strips away all that digital manipulation. And the kicker? If banks are caught using these old tactics, they face automated refund requirements that are paid directly back to the affected account holders.
Next up is Part 4, the AI threat horizon. This is fascinating. We're going to look at how artificial intelligence just created an absolutely unprecedented legal and compliance crisis.
In a twist that honestly sounds straight out of a sci-fi movie, the Supreme Court of India actually had to set aside orders passed by the National Company Law Tribunal. Why? Because they discovered that the underlying legal rulings were entirely built upon completely fake AI-generated legal precedents. Lawyers literally used large language models that hallucinated fake court cases. Imagine bringing a robot to court and it just starts making up laws out of thin air. No way, right?
This flashpoint has caused an absolute structural breakdown in how legal and financial institutions view AI reliability. Because of this mess, the RBI is expressly extending traditional model risk supervision straight to third-party vendor AI. This means commercial banks, fintechs, and NBFCs are now forced to submit strict, board-approved gap assessments. They absolutely must verify data integrity, proactively prevent these machine learning hallucinations, and completely lock down their automated credit underwriting pipelines. The days of just plugging an AI into your network and hoping for the best, yeah, those are officially over.
Finally, let's bring all of this together in Part 5, Market Impact and Fallout. We'll look at the real-world market consequences of this entire July regulatory blitz. The real-world fallout here hits two massive zones. First, for banking and NBFC stocks, you should definitely expect a short-term compression in cross-selling fee margins. Why? Because aggressive sales targets are slamming right into those new automated penalty refunds we talked about a minute ago. Secondly, for tech brokerages and fintech platforms, compliance tracking can no longer be outsourced. They're facing a harsh new reality where system verification protocols must be continuously audited to ensure client funds remain completely segregated.
If you take away just one thing from this explainer, make it this. Regulators are officially looking past your balance sheets. They aren't just looking at traditional accounting sheets anymore. No, they are directly auditing your underlying code layers, they are dissecting your interface architecture to make sure it isn't deceptive, and they are deeply scrutinizing your artificial intelligence integrations, the whole shebang. Which leaves us with one critical, highly provocative question. As the regulatory hammer comes down hard on AI hallucinations and deceptive digital interfaces, is your risk and compliance framework truly ready for this new artificial intelligence era? The regulatory floor has shifted beneath our feet, and keeping your frameworks tight is no longer optional. Thank you so much for joining me for this explainer. Keep your portfolios protected and keep learning.